Monetary Policy and Endogenous Financial Crises. By Frederick Boyce, Fabrice Collard, Jordi Gali and Cristina Manea. Monetary and Economic Department. January 2022. This publication is available on the BIS website, www.bis.org. Abstract. We study whether a central bank should deviate from its objective of price stability to promote financial stability. We tackle this question within a textbook New Keynesian model augmented with capital accumulation and micro-founded endogenous financial crises. We compare several interest rate rules, under which the central bank responds more or less forcefully to inflation and aggregate output. Our main findings are threefold. First, monetary policy affects the probability of a crisis both in the short run, through aggregate demand, and in the medium run, through savings and capital accumulation. Second, a central bank can both reduce the probability of a crisis and increase welfare by departing from strict inflation targeting and responding systematically to fluctuations in output. Third, financial crises may occur after a long period of unexpectedly loose monetary policy as the central bank abruptly reverses course. While monetary policy may not be quite the right tool for the job, it has one important advantage relative to supervision and regulation, namely that it gets in all of the cracks. Stein, 2013. 1. Introduction. The effect of monetary policy on financial stability is ambivalent. On the one hand, loose monetary policy can help stave off financial crises. In response to the COVID-19 shock, for example, central banks swiftly lowered interest rates and acted as a backstop to the financial sector. These moves likely prevented a financial collapse that would otherwise have exacerbated the damage to the economy. On the other hand, empirical evidence shows that, by keeping their policy rates too low for too long, central banks may entice the financial sector to search for yield and feed macro-financial imbalances. 1. Loose monetary policy is thus sometimes regarded as one of the causes of the 2007-08 Great Financial Crisis, GFC. Taylor, 2011, in particular, refers to the period 2003 to 2005 in the U.S. as the Great Deviation, which he characterizes as one when monetary policy became less rule-based, less predictable, and excessively loose. This ambivalence prompts the question of the adequate monetary policy in an environment where credit markets are fragile and financial crises may have multiple causes. 2. What are the channels through which monetary policy affects financial stability? Should central banks deviate from their objective of price stability to promote financial stability? To what extent may monetary policy itself brew financial vulnerabilities? We study these questions within a novel New Keynesian, NK, model, where crises may arise endogenously, for example, after a protracted boom or in the face of adverse non-financial shocks, and monetary policy is the only available policy tool. One caveat of abstracting from other, for example, macroprudential policies is that we neglect their potential complementarities with monetary policy. 3. One important advantage, though, is that this allows us to precisely identify the effect of monetary policy on financial stability, which is the focus of this paper. Our model departs from the textbook, 3-equation, NK model in 4 important ways. First, it features endogenous capital accumulation, implying that the economy may deviate persistently from its steady state and expose itself to macro-financial imbalances. Second, firms are subject to idiosyncratic productivity shocks, in addition to aggregate ones. This heterogeneity gives rise to capital reallocation between productive and unproductive firms via a credit market. 4. Third, we introduce financial frictions that make this credit market fragile, that is, prone to collapses. One friction is that investors may not be able to seize the wealth of a defaulting borrower, thus allowing firms to borrow and abscond. This limited enforcement problem induces investors to constrain the amount of funds that each firm can borrow. Another friction is that idiosyncratic productivities are private information. Together, these frictions imply that the loan rate must be above a minimum threshold to entice the least productive firms to sell their capital stock and lend the proceeds, rather than borrow. When the marginal return on capital is too low, not even the most productive firms can afford paying this minimum loan rate and the credit market collapses. This is what we call a financial crisis. Most crises in our model break out toward the end of a protracted economic boom, when there is excess capital in the economy and the marginal productivity of capital is low. Crises are characterized by capital misallocation and a severe recession. Finally, the fourth departure from the textbook model is that we solve our model globally, which allows us to capture the nonlinearities embedded in the endogenous booms and busts of the credit market. We study whether monetary policy can tame such booms and busts and, more generally, whether a central bank should deviate from its objective of price stability to promote financial stability. In the process, we compare the performance of the economy under simple linear interest rate rules, nonlinear rules, and monetary policy discretion. Our main findings are threefold. First, monetary policy affects the probability of a crisis not only in the short run through its usual effects on output and inflation, but also in the medium run through its effects on capital accumulation. In particular, policies that systematically dampen output fluctuations tend to slow down the accumulation of savings. The lower saving rate stems excess capital accumulation and helps prevent financial crises. As these effects go through agents' expectations, they require that the central bank commit itself to a policy rule, and only materialize themselves in the medium run. Second, a central bank can increase welfare by departing from strict inflation targeting, henceforth, SIT, and responding systematically to fluctuations in output. For example, we show that welfare may be higher under a Taylor-type rule, whereby the central bank responds to both inflation and output, than under SIT, even though the latter policy is optimal in the absence of financial frictions. Third, we study the effects of discretionary monetary policy interventions, that is, deviations from the rule, on financial stability. We show that financial crises may occur after a long period of unexpected monetary easing, and break out when the central bank abruptly reverses course by raising its policy rate. At last, we discuss the welfare gain of following more complex, albeit perhaps less realistic, monetary policy rules, whereby the central bank commits itself to doing whatever it takes whenever needed to forestall crises. We find that such policy significantly improves welfare but also increases the fragility of the financial sector, forcing the central bank to backstop the financial sector relatively often. Our main contribution to the literature is to study how monetary policy affects financial stability within a NK model with endogenous and microfounded crises. As we do so, we bridge two strands of the literature. The first is on monetary policy and financial stability. Like Woodford, 2012, and Gorio, Kashyap, and Sim, 2018, we introduce endogenous crises in an otherwise standard NK framework. 5. The main difference is that they use reduced forms to determine how macro-financial variables, for example, credit gap, credit growth, leverage, affect the likelihood of a crisis, whereas in our case financial crises, including their probability and size, are derived from first principles. This has important consequences in terms of the prescriptions of the model. One is that, in our model, monetary policy also influences the size of the recessions that follow crises, and therefore the associated welfare cost. Another is that, even though crises can be seen as credit booms gone wrong, as documented in Schuleric and Taylor, 2012, not all booms are equally bad and conducive to crises in our model. Gorton and Ordonez, 2019, Sufi and Taylor, 2021, a key element to determine how hard to lean against booms. More generally, our findings do not depend on any postulated reduced functional form for the probability or size of a crisis. In this sense, our model can be seen as providing micro-foundations to existing models such as Woodford, 2012, and Svensson, 2017. The second strand of the literature relates to quantitative macro-financial models with micro-founded endogenous financial crises. Girdler and Kiyotaki, 2015, Boyce, Collard, and Smets, 2016, Girdler, Kiyotaki, and Prestipino, 2019. 6. The novelty here is that we use our model to study the link between monetary policy and financial stability. Ours also complements existing work, for example, Girdler and Kiyotaki, 2015, Girdler, Kiyotaki, and Prestipino, 2019, in that it focuses on the fragility of financial markets, as opposed to institutions, and highlights excess savings and capital accumulation, instead of excess bank leverage, as a source of fragility. Our paper also belongs to the literature on the transmission of monetary policy in heterogeneous agent New Keynesian, HANK, models. Most existing HANK models focus on household heterogeneity and study the channels through which this heterogeneity shapes the effects of monetary policy on aggregate demand. Guerrieri and Lorenzoni, 2017, Kaplan, Moll, and Violanti, 2018, Oaklert, 2019, Di Bortoli and Galli, 2021. In contrast, our model is on the effects of firm heterogeneity, as in Adam and Weber, 2019, Manea, 2020, Ottonello and Winberry, 2020, and the role of credit markets in channeling resources to the most productive firms. Though in a more indirect way, our paper is also connected to recent works on how changes in monetary policy rules affect economic outcomes in the medium term, for example, Borio, Disyata, and Rungcharenkitkel, 2019, Baudry and Meh, 2021, as well as to works on the link between firms' financing constraints and capital misallocation, Eisfeld and Rampini, 2006. In particular, the notion that financial crises impair capital reallocation dovetails with the narrative of the GFC in the US and the literature that shows that a great deal of the recession that followed the GFC can be explained by capital misallocation, for example, Campello, Graham, and Harvey, 2010, Foster, Grimm, and Haltwinger, 2016, Argente, Lee, and Morera, 2018. The paper proceeds as follows. Section 2 describes our theoretical framework, with a focus on the micro-foundations of endogenous financial crises, and describes the channels through which monetary policy affects financial stability. Section 3 presents the parametrization of the model as well as the average macroeconomic dynamics around financial crises. Section 4 revisits the divine coincidence result and analyzes the trade-off between price and financial stability. In Section 5, we study the effect of monetary policy shocks on financial stability as well as whether a central bank should commit itself to forestall crises. A last section concludes. 2. Model. Our model is an extension of the textbook NK model, Galli, 2015, with sticky prices a la Rotemberg, 1982, and capital accumulation, where financial frictions give rise to occasional endogenous credit market collapse. 2.1. Agents. The economy is populated with a central bank, a representative household, a continuum of monopolistically competitive retailers, and a continuum of competitive intermediate goods producers, henceforth, firms. The only non-standard agents are the firms, which live one period, are ex-ante identical but experience ex-post idiosyncratic productivity shocks that prompt them to resize their capital stock and participate in a credit market. 2.1.1. Central bank. The central bank sets the nominal interest rate on the risk-free bond according to the following simple policy rule.